We use our cutting-edge technology and collaborative client-focused brokerage team to provide the highest level of professional service at all stages of our clients' investments. Our team has decades of experience in all types of markets, guiding clients through some of the most challenging times for investors. Our all-hands-on-deck approach generates more offers on your listing, and according to CoStar, we have sold our listings faster and with the highest list-to-close percentages over the past 2 years. For buyers, we identify and negotiate the best terms possible, ensuring your long-term success. We hope your time with us today helps your passive investments become massive investments. Centennial Advisors, here for you now and always.
Good afternoon, everybody. Welcome to our webinar on March 23rd, 2023. I'm Justin White, Managing Director of Centennial Advisors. I'm joined by Jason Brooks and Buckhalter. There's been a lot of things going on since the last time I think we got together. Certainly we'll talk about some real estate stuff here in a second, but I think since the last time we did this, Jason might have had his baby. So how's Ford doing?
Ford's doing great. Thanks for asking.
Fantastic. In addition to that, there's been a ton of things on the real estate side. We've got an agenda and a plan for you to talk a little bit about the differences or the comparison between owning and leasing the property for your business. But I think there's a lot of timely things that maybe we'll get to first today that are on everybody's mind. Since the last time we got together, Jason, we've certainly seen some changes in banking. I don't think I really want to go into today what do we think about a couple banks closing? Because I think that's probably a topic that everybody that's in the real estate business has chimed in on. But I want to talk more about kind of the lending environment and changes since those two banks have shut down. I was talking to David Babor, City National Bank, today over at a lunch for the Long Beach Chamber of Commerce, and he was like, how's it going? I go, well, it's not too bad. We're making stuff happen, but it seems like it's going to be a lot harder to get things done. And his general feedback was, yes, underwriting is significantly changing right now. Things are getting a lot tighter. Jason, why don't we start there? Why don't you make some comments? I know that you work with a lot of different clients and a lot of different products, and talk about what you're seeing changing maybe in the lending environment, from, let's call it, bank aggressiveness, underwriting standards, things that investors are going to have to be prepared for that might be a little harder than what we were seeing, maybe this time last year.
Yeah, so I think one of the things that we're seeing is a lot of people end up with like private debt funds for their deals instead. Historically, there was a 200 to 400 basis point spread between a bank or a traditional lender and a private debt fund. And today, I think that spread can be anywhere from 100 basis points to 200 basis points, but the restrictions, the ease of getting the debt is probably worth it. The underwriting's not as tight. A lot of the banks now are pushing for depository relationships in order to lend you the money. So the more bigger deposits you have, the more likely they are to make the loan to you, or the bigger loan, or they'll give you multiple loans. So I think what we're seeing really is a move towards private debt funds, and they tend to be pretty active now. Not many of them have pulled back, at least the stable big ones, because they see an opportunity to get in on assets that they wouldn't have gotten in on, 3-4 years ago when, banks were at 3.5% to 4.5%. And the debt funds were at 7%. Now the debt funds are probably at 8%, but the banks are at, 6.5%. So I think there's a real play there. Now, remember one thing, most of the time those loans are only 18 to 36 months. So it's more of a bridge until no prepay. So it's a bridge until you can find an opportunity to get, long-term stabilized financing.
So maybe real quickly summarize what you see as some of the benefits to a private debt fund relative to more conventional financing today.
Yeah, so private debt funds tend to move much faster. They usually, or still probably today, will give you a higher loan to value than, a traditional bank will. They might be open to non-recourse options, where I feel like most banks are only doing recourse loans right now. And then, if there's a construction loan, almost all the construction loans, and talking to some construction lenders, are coming through them, but the draw process to get money out is faster. They'll do value add loans, which build in construction budgets. And so I think, the underwriting is similar in underwriting the quality of the asset and the quality of the borrower. But they're more aggressive and, they just move faster, right? So the speed is everything, I think, in these deals right now too.
Okay. And don't know exactly the variety of your pipeline right now of business, but talk a little bit, maybe some of the, let's call it last minute bank retrade, things that you've seen banks ask for. You mentioned one a second ago, bank deposits and increasing deposits in the bank. We did a assumption the other day where they significantly cut loan dollars. What other things are you seeing, let's call it mid-transaction, changes in bank underwriting or additional requirements?
Well, Justin, a couple of the loans that we just closed for one of our clients together, one closed yesterday, I think one's closing tomorrow. Those loans were interesting because Bank of America did 2 loans originally for the client, one that closed yesterday and one previously, and they were open to, doing the rest of the loans for this borrower. And it's an extremely strong borrower. These are, 50% LTV, 7-Eleven brand new construction assets. And all of a sudden, halfway through, I get a phone call from the lender at Bank of America that got our number from the broker. And they said, look, we're happy to do the rest of the loans at what we agreed upon, but we need all the deposits for the company to be at the bank. And I'm like, that's not what the term sheet said. And, they said, well, the term sheet can change. It's not fully binding. We've seen rates move, mostly rate floors or spreads, because there has been some volatility in the 10-year treasury market where, people are trying to play a rate lock game. But, we had a client that broke a rate lock in January and it cost him $150,000 break the rate lock, but he re-rate locked at 75 basis points lower. And we figured out that in payment alone, I think it was 7 months was the delta to make his money back. So
it can work out sometimes.
It can, right? But that's if you can break the rate lock. Some of the banks are, not going to let you break it to go down, but then they're going to break it if they don't like how low it is, or they'll find a reason to retrade you up, or they'll find an excuse to lower the loan dollar proceeds to get you to come in with more capital. So there's a lot of, you really don't want to shake the tree right now once you're locked in with a lender and try to change anything.
Talk for a second, maybe just things you're hearing from clients as it relates to the underwriting of properties changing.
Loan to values are going way down. Loan to value is way down. They're underwriting. I think they're just underwriting a much higher debt service coverage ratio. So for those that don't know what that means, it looks at how much cash you have monthly on average coming in the door. And then it looks at what your debt service is. So let's say I have $30,000 in cash flow coming in and my debt service cost is $15,000. So in reality, I should have $15,000 to play with. Well, most lenders want a debt service coverage, let's say of 1.25, which would mean they want you to be able to have that 15,000 plus 25% on top of that 15,000, which is another $3,750. So they would want to make sure that, you had $18,750 in cash flow. Well, now some of them are upping that debt service coverage. So let's say a 1.5, which would mean now you have to have, 22,500 in cash flow. So, it starts to, that doesn't mean you have to pay it down, but they just want to make sure that you're protected.
There's been a lot of change. Debt coverage ratios, we've seen expenses start to change a lot. And the underwriting that banks are using much more conservative on what things are going to cost going forward. Obviously, we've had inflation in a lot of places, and they're naturally adjusting to rising costs, but we're kind of all coming together at really the same time. Jason.
By the way, Justin, on that topic, I had a lender in a Los Angeles-based transaction, LA City-based transaction, starting to underwrite the ULA tax now on people's exits to make sure that because they want, if they're lending you, let's say they lend you 65% loan to value. If something goes wrong, even if you lose money, you have to pay an additional 4 to 5.5% on tax, right? So that's going to lower their collateral is at greater risk, right? And so that's an exit cost. If you look at LA transfer tax plus the high level ULA bracket, that's almost 11% between the two.
Any other
At 65, well, at 65% loan to value, you take 11% off, right? Like your delta starts to your equity gap starts to shrink a lot. So,
any last comments here on, let's call it, banking and the lending environment, with, whether it's more debt getting called, more people walking away from debt. We're starting to see more of that. We're starting to see let's call it a worrisome number of that from your end. What are you hearing?
there's a lot of debt that's being walked away from right now, and it's big, high-profile debt. So that tells you most of it is probably big CMBS debt on office towers or big buildings in New York, Chicago, Los Angeles. Um, Loans are going into default. I mean, even the Century Towers, the new Century Plaza Towers in Century City, which is the Fairmont Hotel and the branded condos, is in default. I think the loan was like $2 billion. I haven't heard of many of the smaller loans. Many people refied into fixed rate debt over the last 3 to 4 years, and the minimum term on that fixed rate I think was 7 years. And so many people have some time left, but some of those bigger CMBS loans are starting to go back, and they're going back in a hurry.
Great. I appreciate all those comments as it relates to the lending market. Avi asked a question. I'll let you answer, and then I'll jump on it. Are you seeing properties fall out of escrow more?
Yes. And I think they're harder to get into escrow too. I think that there's a lot more work. People are getting a lot more creative. We have a deal right now that we're doing where our client's selling an apartment building and then 1031ing into a new apartment building, both in Orange County. But they got their 1031 up leg into contract first, and we were able to get them in a contingency so they removed all the contingencies, but they had a 30-day contingency to get their down leg into contract and non-contingent. And if they didn't get their down leg into contract and non-contingent within 30 days, they could still cancel and get a refund of their deposit. So people are just getting more creative to, make deals work when they do, but there's a lot more deals canceling because of the fine. I had a client that just got a closing delay because one of their LPs that was 50% of their equity was a Silicon Valley Bank depositor. And they said, while they're getting all of their deposits, there's a freeze on it for 90 days on an amount over like $1 million. And the LP amount was substantially larger than that. So they're kind of they don't know what to do because the deal's in limbo. It was supposed to close, and then the client couldn't access their capital.
Avi, my comments on, are we seeing properties fall out of escrow? I think it's interesting right now. There's still plenty of people that are looking to acquire the right asset. High quality locations, good tenant buildings that fit what their portfolio, is currently comprised of, or where they want their portfolio to go. We don't see a lack of interest from people on well-priced inventory. I think the real key on keeping deals in escrow is probably more the front end analysis of the buyer, where their capital's coming from, what their lending source is, what their real desire and motivation and business plan is, and does that stuff all match up? Because if you look at it from a seller's perspective, today may be the better opportunity to make the deal than down the road. And so making sure that you do your best to go under contract with the right person, I think is really hypercritical right now. Back when there's 7 offers and it's list price or die, you can pick just about anybody. But now that selection process, evaluating who are the interested parties and making sure to pick the right one, I think is a big part of certainly what we're doing at Centennial to maintain the integrity of the deal, the pricing, and putting the deal in escrow once versus, let's call it, 3 or 4 times.
And Justin, you made 2 interesting points. The first was well-priced items, and maybe you want to talk about that because you guys have had some real success, I think, in the last couple of months, helping both buyers and sellers. But maybe talk about the pricing side, because I think that's spot on. Is like well-priced deals are still moving.
Yeah, I'm happy to talk about it. I think that's the kind of the big thing we've seen in the market when it comes to the brokerage side and helping sellers, is that the pricing strategy of a year and a half ago or a year ago was price it above everything that's currently closed or on market, and the market will catch it before, the quote unquote, the listing expires if somebody was trying to maximize price. And today, I do think it's a lot different. Well-priced properties, and that's not, a giving it away price, but just something that makes sense in the market and looks like the most attractive building on the market today, gets a lot of interest. Whether it's an apartment property, an industrial building, a well-located office, even a well-located small office is probably the right way to put it, and a net lease property, those see a lot of interest. But when they're priced right, they see interest from multiple people. There is a big difference in the interest and activity level of offers you get on a property that what I would call as well-priced versus something that is shooting for a number that is too optimistic, is based in I want, not what's happening in the market. Those properties are totally on the other extreme and almost getting no interest. The offer activity really has kind of moved to, you get a bunch of offers, and the stat that I shared with the seller the other day was that of our last 11 listings that had closed, our average number of offers before it went under contract was 6. And on our properties that weren't meeting the market, our average offer activity was 0. So Jason, I'm glad you brought that up and gave me a chance to talk a little bit about the value of well-priced and the value of somebody telling you where the real pricing is, and helping a seller understand where real pricing is maybe one of the biggest values a broker can bring to the table. And it's a tough one, because if you have competition out there, they're telling people the price that they would love to hear that's not realistic. It takes a lot of integrity, and it takes a lot of, responsibility to do right by somebody, to just say, hey, this is where it's really at. This is the highest we think we can get. And we obviously want to get you the highest. We want to set records too, but you got to have those honest conversations today.
Well, and to that point, I think if you overprice something, then, and it sits there and sits there and sits there, it looks stale, right? It gets stale over time. And then you have to end up doing, let's say, a big price reduction. And then all of a sudden, that huge price reduction, right? Not like a small reduction to say, hey, like, look, we're sellers, we're interested, let's get this done. But a big price reduction to bring you down to where the market should be, all of a sudden looks like, sharks in the water, because, all of a sudden a huge chop on the price, they must need to get rid of it. And I think the other thing you brought up, Justin, was doing a lot of diligence on the buyer up front. We've seen a few times recently where it's not the highest price offer that is winning anymore. It is a lot of times, the buyer that has the highest certainty to close, right? The buyer with the best terms per se, and not just the highest dollars. And if you want to talk about what you guys are seeing there too, because I think that, like, certainty for sellers is sometimes more important than the few extra dollars.
Yeah, I think in today's market, that's a huge one, because you said a couple important things there. Each property really kind of gets its window to be the building that everybody's looking at. And when we get some competition, we try to do a really good job of vetting every single one of those prospective purchasers, not only the purchaser and what their business plan is, what their portfolio looks like, what their how much capital they have and how much reserves they have beyond that capital necessary to buy, who is their lending source, and is that lending source the most qualified, and then also who's representing them and who's bringing them to the table. All those things matter, in addition to how long the due diligence period is going to be, what the deposit is, and what's the price. They all play a much bigger role today in getting somebody the highest net dollars at close. So yes, to your point, we've had some offers come in that, the number looked really good, but it was, wolf in sheep's clothing. There was nothing behind it in quality of the broker, quality really of who the buyer was, what their business plan is, or that they could even get the deal done. And to some of our clients' credit, they've allowed us to compile all the information on a variety of buyers. And they've ultimately selected the people that are getting across the finish line. and getting them across the finish line at the best price and terms for whatever they want to accomplish is not just looking at that big high number and hoping that that's going to work, because hoping is not a successful strategy today. Going back to pricing, Jason, one of the things that I try to encourage clients to consider when they are bringing a property to market is we are still at a time where there is great offer activity. A well-priced property is going to get good offers. Is that because there's enough offer activity out there, you can't undersell a well-marketed property. And what I mean by that is sometimes sellers are like, well, I want to be at X because I'll maybe negotiate a little bit and we'll see what happens. And sometimes that X number turns everybody off. Whereas we've seen a lot of clients be successful lately where we'll come in and say, hey, this is where we think the value is. This is where we think it's ultimately going to sell. And they are going at exactly that number, or they're encouraging us to take it out at maybe slightly lower and letting the competitive bidding environment show them exactly what is the highest price that they can get in the market. And after doing this for 20 years, my observation is clients have a much better feeling that they got the absolute highest price if 10 offers competed and somebody did what they had to do, not what they wanted to do, versus sitting on the market for 3, 4, or 6 months and getting one offer and having to take it. They always wonder, was that one the best? Versus if they get 10 offers and people compete and they come up 50, 100, 200 grand, $1 million, they know that the market spoke and they got the absolute best that they could.
I don't think sellers ever care if there's multiple offers. Like, I don't think anybody's ever complained like, oh, you got me multiple offers. It tends to be a positive situation.
Yeah. And it's really, today it's, I think, even more critical. We have a lot of clients. We've been saying this and, doing this 20 plus years and looking back on all the exchanges we've done, the clients that had the most profitable exchanges were the clients that came to market in 2009, 2010, and repositioned their equity into bigger, better properties, and then rode this market up to the last run of the market in bigger, nicer, better properties. They absolutely killed it. Most people will do an exchange, the market's going up and they sell high and they buy high. But a lot of our clients sold when the market was maybe trending down a little bit, repositioned when the market was down a little bit more in a better asset. And then because they had a lot of equity and they were smart about the amount of debt that they brought to the table, they were able to ride out any more, decrease in price in the short term to reap all of the benefits of the long term. And I think that that's a big one to be considering today, is that there really are great opportunities for owners that have owned a long time in really strong equity position, that maybe their cash flow needs have changed, their desire to be hands-on management have changed, where they live has changed, or what they want to own 10 years from now has changed. And now with fewer investors in the market, there's still a good number, but fewer, they have the opportunity to make some of these trades to really reposition themselves to enjoy the benefits of the next run of the market in higher quality property.
Well, and to that point, most of the people that have owned assets for that extended period of time are usually running on a lower side of the leverage. And so with less leverage, then they have less constraint when they 1031 into the upleg. Like, they can take more if they want to, but they have a lot more equity now that is built-in equity, right? It's accrued equity that they can now trade up into something bigger, and then they'll be under levered on their upleg transaction, or they can lever up on the upleg if they want to, but they're essentially, without refinancing and pulling that equity out and buying something else, they're just equity up into a greater asset.
Yeah, absolutely. It's when you have 75 to 100% equity in your property, you can leverage a little bit and not really be exposed to interest rates, but control a much nicer or bigger building for the long run. And then as rates drop and values and rents increase and values increase, it's a wonderful ride to be on. Jason, let's transition a little bit. I
Sure.
want to quickly get into some product type stuff and just maybe each of us give our quick comments on what we're seeing in that particular space. I'm going to start with apartment buildings. What are you seeing there? What's kind of the feedback that your clients are giving you on where that market's at?
Um, Deals are happening. The cap rates are higher. Financing is not as aggressive and as much as it was. So, when you were getting 65, maybe 70% at really low rates, now you're probably closer to 50% on a lot of the deals. We had someone the other day get quoted. The best that they could get was like in the 40%. So lower leverage, I think, is the big thing to keep in mind. I think that's the big thing I'm seeing in the apartment space. I will use this opportunity to quickly mention that LA County did not extend their eviction moratorium at the meeting. I think it was on Monday or Tuesday. Now they still had 7-8 days, and they could do an emergency session, and then they could extend it again. But as of today, it looks like for now that all the eviction moratoriums are going to be off in LA City and County going forward. So I think for a lot of very frustrated owners, the opportunities are now coming to, substantially remodel units, evict tenants for non-payment, start those processes, which, can make your building look more attractive if all of a sudden you're raising your NOI either through, higher rents or just a tenant that pays in general. So.
This is a perfect time, and I'll make my apartment comments in a second, but it's a perfect time to remind everybody that we use the chat function, which is on the right side of your screen, as the way that we typically have people ask questions. So as we get into, which I'm sure will be another question or two regarding LA County and rent control and evictions, use that to ask us any questions. My take on the apartment market would be, simply, as Jason said, cap rates have gone up. Cap rates have not gone up the same amount as interest rates have gone up. Operations still, high. Rents, usually people are renting higher than when the person moved out. So all those things, fundamentals still very strong, but a little bit of pricing adjustment, and we're still seeing a good appetite of people selling to improve, trade up. As well as people continuing to acquire and add to their portfolios.
I think Justin rent strength is fine, right? Like the buildings are highly stable. There's low vacancies. The rent numbers are good. It was just more of like on a transactional side, what's going on. But you're right though. As an owner, it's a great time, right? Like rents aren't going down, and there's plenty of people that won't be in your building.
Let's talk about net leased.
I think that was a great time to buy net lease transactions because cap rates are substantially higher than what they were a year ago. So I think it's a good, if this is something you want to be in, you're going to get an extra 100+ basis points on the exact same property today as you would have a year ago, which for those that don't know what that means, you're getting 1% more return on your equity, but then as you factor in rent bumps over time, then you're growing at an even more exponential rate as well.
Simply put, tenants and locations that were selling in the 3.75 to 4.25 range for very high quality long-term leases are now 5.25 to 5.5. And probably pushing even a little bit higher over the next few months. Little anecdotal story. We're working with somebody who was brought to us because they needed some exchange help in finding a net lease transaction. And we've known the market is moving. We've known that there's been opportunity to get higher cap rates. And the first couple LOIs we wrote got such great response. I was like, all right, we need to try higher cap rates. And it's just different. It's a different marketplace. The sellers of those properties are a little bit more, I'm going to say, fundamentally driven or formula driven. And because of their cost of capital, because of their hold times, it makes more sense to meet the market, however aggressively that needs to be on a property, especially on the development stuff. And that pulls the sale leaseback market with it, whatever it may be. So we've seen really big moves in the net lease cap rates. My comment would be, I've seen net lease across the country with really high quality tenants move at a significantly bigger number than any of the, let's call it local product type cap rates. Jason, you want to make a comment on that? So you seen
Yeah, it's funny. We have a client that bought 2 gas stations from a private equity fund backed company. Essentially, they had 1,000 units when we bought them a year ago. I think it was like a 5.35 and a 5.4 cap rate between the two. We ended up not buying them for different reasons, but we went into contract on 2 other ones at a 6.75 on both. And the difference between now and a year ago, besides that percentage on the cap rate, is that 1,000 brand private equity company acquired another company that had 2,000 locations. So they went from 1,000 location guarantor to a 3,000 location guarantor. And they folded in their oil change business, which gave them another 1,000 locations. So essentially, we went from getting 1,000 unit guarantor to a 5,000 unit guarantor. Same company, same publicly traded private equity back, and 135 basis points higher on the cap rate. So
there's different opportunities in the market at all times. And, I think that that's one of the things that when you really want to help people do better and you take a lot of pride in helping owners, families, use their equity wisely, that when things like this happen in the market, you hear a lot of, I'm just going to sit tight. I'm going to wait and see. I'm not going to do anything. And these are where some of the greatest opportunities exist. I was talking about the multifamily, trader into something better and easier and closer to home, and how profitable that was 10 years ago when people did it kind of at this same stage of the market. And Jason brings up, if you have any interest in net lease, like this is an opportunity where, maybe the cap rate on your apartment building moved 30 or maybe even 50 basis points, but you can go acquire a net lease deal with maybe a better tenant at 125 or 150 basis points higher than the top of that market. So there are great opportunities when people are looking for them in the marketplace today. Jason, let's talk a little bit more. Let's talk a little bit about retail. What are your comments there? More of the strip center, shopping center sort of segment of the market.
I think the strip center shopping center market's pretty good. If you've got 1 or 2 decent anchor tenants, like it's not big, right? But like a, cell phone company or whatever they are, good tenants there, you're doing pretty well. I think some of the larger retail institutions are having trouble. Some are great. I think it's feast or famine on the large side, but I do think that there are, a lot of transactions and a lot of successful opportunities and properties that are doing well on the smaller strip center size of transactions.
For us, I think what we're seeing is that the service oriented retail is doing fantastic. We've got a really nice listing in Long Beach right now that is a mix of restaurants, doctors, professional service, tutor. You got to come, and get the experience, whether that's cavity or, self-defense lessons. But those sort of, that to me, that's the transition of that retail has gone to from the traditional, clothing store, et cetera. And those are doing really, really well. And the tenants are successful. The tenants' business is great. Vacancy is low. We're seeing those be really resilient. And if you can get ones in great locations where the neighborhood is coming to that place to do their things, those are really good right now. And they're offering maybe some better caps than what we're seeing in the multifamily and in the industrial side for a mix of tenants that can be as strong as a apartment building or an industrial. Let's talk a little bit about industrial, Jason.
Yeah, now's an interesting time in the industrial space, especially given
the sound so bullish on it earlier.
No. I think industrial, if you're looking to lease industrial space, I think now is going to be a great time. I think if you were a larger industrial owner, an industrial developer, now is going to be a very difficult time. There was a lot of industrial through the pandemic that was being built on spec with the assumption that people were just going to take it. And over the last 6 months, companies like Amazon have come out and said that they're not renewing a substantial portion of the leases that they have coming due. They're canceling on like a third of the product that they committed to during the pandemic that was in development pipeline. And they're not the only ones. And you've got a lot of developers that were out there building, two 900,000 square foot buildings. They found one tenant for half of one of the 900,000 square foot buildings. So they're like, boom, we got that one half tenanted. We're going to start the next one. And now all of a sudden they're 75% of the way done with the next one, and they have the one tenant still. And they're going to be sitting there, with like 1.3 million square feet that's completely empty. I think the good, solid industrial right now is the one that's like an owner occupied, which I think we're going to maybe potentially talk about in a minute. But, owner occupied, smaller size, 1 to 2 user, those things will always have tenants. I just think some of the larger scale industrial is going to be in a little bit of trouble.
Fantastic comments. And maybe some comments that kind of go in the opposite of what, we've been hearing and what the reports talk about of 2% vacancy here and 0.5% vacancy here. It's, industrial's been on a really good run, especially in Southern California, with, supported by all the port activity as the logistics and warehousing space has taken over a lot of what used to be manufacturing, and we've seen redevelopment of the 10 or 12 foot brick manufacturing facility for airplane parts become a 32 foot warehousing facility. It may continue, but I think that Jason brings up some good points and some good challenge to that. Markets are somewhat cyclical. And if you don't see the super rosy opportunity, maybe now is a good time to sell some industrial and take some chips off the table, because those chips are certainly have gone from red to black over the last 10 to 12 years in a lot of the areas that we serve our clients. All right, Jason, that's going to get us. Let's talk about office real quick.
Sorry, I was reading Avi's question, but we'll talk about office first. So I think the office market's really interesting. I've been spending a bunch of time for the firm in the Nashville market, which has been really interesting because during the pandemic and through even before, a lot of major companies made announcements that they were moving or creating second headquarters, and they were building spaces. So for example, Amazon announced they were going to hire 25,000 people here, and they built 2 massive towers. They have since adjusted that hiring down to 5,000 people, and they are only going to fill half of one of the towers. And then they are just completing the exterior shell and interior core of the second tower, and they are going to leave it empty until they figure out who's going to tenant it or what they're going to do with it. Oracle said that they were going to hire 15,000 people here and build almost a $2 billion facility. And they got a bunch of tax credits for it. And now the facility development's completely on hold, and the talks of hiring anybody here is on hold as well. Maybe they'll do 1,000 people instead of 15, they said. So I think the office space, I think even Amazon put a pause on their second office space in Virginia, the second HQ. I think office space is in a lot of trouble. If you follow The Real Deal or some of the other bigger news outlets, a lot of the buildings that are going back in New York City are office buildings. So I think office is in a lot of trouble. I don't know if there's any way around it other than, maybe people can take this opportunity to convert it to low cost housing or lower cost housing, repurpose it. Because it'll be, I don't think if you can buy it below replacement value, which I think most of them are going to end up selling at.
Couple things, comments on office. CoStar's front page of news had 5 articles about how bad big office was headed into today. Sat with a client the other day who was excitedly targeting Class A office that he felt he was going to be able to buy for between $125 and $150 a foot. Class A office, Class A locations, already seen some of those opportunities. It's way different. Number 2, as somebody who's looking for 3,000 to 4,000 square feet right now, I could probably get a better deal on a whole floor at 12,000 to 15,000 square feet in a Class A building than I could get in a suburban location, first floor, no amenities, C plus B class building for 3,000 feet. It's an interesting time. As it relates to office. All right, let's talk about Avi's question on warehouse, and then we're going to go back to apartments, and then we're going to maybe try to squeeze in this lease versus buy thing. that we were going to talk about today, but hopefully everybody's enjoying the content and the conversation. And if we don't get to it today, Jason and I will cut the buying, leasing here in the next couple of days. So let's talk about Avi's question. By the way, Avi, thank you for your participation. Avi has figured out how to work the chat. If anybody else wants to ask some questions, please use the chat and we'll get to those as well. Do you anticipate bigger warehouse, 50,000 square feet plus, going down in value versus smaller size, let's say 12,000 square feet and smaller?
I'm going to say generally yes. I would tell you that a well-located property, right, will always be fine. For example, if you have a 50,000 square foot office or warehouse down by the port, you're always going to find a tenant for it. But I think on average, yes, you're going to see a much larger decrease in value and decrease in rental rate from those massive spaces, because the tenant pool for 50,000 square feet plus is less than the tenant pool for 12,000 square feet. And so it's a supply demand issue. And that's just, that's how I'm seeing things. Justin, you guys are in this market more, but I think based on, we have some institutional industrial developer clients, and like, these are discussions we're having now, especially when they're 65% of the way through construction and they have a half empty other building, and the one next to it is the one 65% of the way done.
And I think, yes, the first thing you said, or part of what you said that I think is always the most important, is especially now, good location matters more, and good location will be occupied, whether that's in the right industrial park or the right clear height or the right power, whatever it may be. Those things are going to be highly occupied. I do think that there's certainly a big appetite for warehousing and even still last mile operations, even with Amazon controlling or reducing some of their growth. So I'm maybe not as pessimistic as Jason, but these smaller size buildings, I think we will continue to see very, very high occupancy in those. For the entrepreneur and small business that needs those sort of spaces, they want to control their own destiny. They want to, they have the capability to invest in their business and use some of their proceeds to invest somewhere. And it's easier to just invest in your own building. And I think that, smaller spaces are where people start businesses as well. And so those will, continue to see probably a little bit more resiliency. I also think that a market like Southern California, while yes, there has been a lot of development and maybe a significant, we've seen a lot of places go up. There is such a high volume of stock already that the additional space in the marketplace is not a huge percentage as it would be in some of these, other markets across the country that have seen, millions of square feet get added to a market that has millions of square feet. Southern California has billions of square feet. So I think that is also going to, it's market driven too. Well, I think that yes, in Southern California, maybe larger product will go down a little bit more than smaller product. I don't think that they're all going to be empty, and that we're going to see industrial values back at under $100 a foot, like they might have been 15 years ago. Thanks, Dave. Great to hear from you. It's been a while.
I think, Justin, too, on like a 12,000 square foot building, if let's just say the average smaller user needs 4,000 to 6,000 feet, you can chop that 12,000 foot building into 2 or 3 spaces and, occupy it with smaller tenants. The 50,000 square foot building, now you're all of a sudden, if you had to do the same thing, you're looking for 8 to 12 tenants. It's just, that's the part of the issue too, right? Is if you have some of these large vacant buildings, what's going to happen?
Well, yeah, and they're not necessarily designed to have some of the amenities or attributes for 8 or 10 small tenants.
Right.
There's bathrooms, offices, parking, whatever. it just makes it a lot harder on those trying to break up those bigger buildings. Jason, let's talk a little. You mentioned it on the apartment side, but I think it's worth more conversation. And that is the LA County Board of Supervisors vote on Friday night at 6:30 to elect to not continue the COVID-related eviction moratorium. Before we make some comments, I'm going to ask you to get everybody up to speed, how long it's been, what it's done, what has happened along the way, because I think it's this exact thing that's made our webinar so famous, or at least got us started. So get everybody up to speed for those that are maybe new, or why it's so significant. I heard some really interesting information from Fred Sutton today of the California Apartment Association as it relates to that vote that I'm going to share after you get everybody kind of up to speed and caught up.
So let me go on record of saying I think I've said about 7 or 8 times that I thought it wasn't going to get extended again, and it kept getting extended. So I think I stopped making predictions. But it's been voted on, so I'm going to say fingers crossed it's over. I don't want to jinx it. I believe the eviction moratorium has essentially been in place since April 1st of 2020, thereabouts. I think the COVID emergency order started around March 17th, and then the eviction moratorium happened. In LA, it's been a little bit, city specifically more than county, it's been a little bit different because not only has there been no evictions, and that's for non-payment of rent, just cause, no fault, just cause. Any form of eviction was pretty much outlawed unless it was like your tenant was committing crime, threatening life and safety of people, breaking the law in very bad ways, or risking other people. What?
At the property. That was
at the property. Oh, you could do it off the property and you can't get evicted for it. I don't think even if you're doing it off the property now, you could get evicted for it, but at the property specifically. So you couldn't evict for any reason. And actually trying to file for eviction incorrectly could lead to fines and other things. In LA City, there was and I think it's still in place though, a freeze on increase in RSO rents. So the measly 3% that you were allowed as an RSO, or rent stabilization, rent control landlord, was even put on pause, and the expenses were skyrocketing for a lot of folks. So I don't know if they're going to stop the rent freeze. I'm sure that'll probably come into play at some point. But you can now evict tenants, and you can evict them to do owner move-ins. You can evict them to do substantial remodels. In rent-controlled areas, there are set fees for a lot of these things. But if your tenant owes you $50,000 and hasn't paid in forever, paying them $10,000 to go away so you can start cash flowing again is better than, having them fight and then file for bankruptcy and file for 6 extensions and try to make the eviction take another year and a half.
Okay, I'm going to have you talk through the process now, and maybe a little more detail of who can and can't get evicted. If you need to do some quick checking to make sure you offer the right guidance, feel free. I'll talk for a minute.
Why don't you talk for a minute, because this thing changes a lot. So.
Exactly. So the thing that I want to tell you that I think is really most interesting about this is that it looked like it was going to pass again, or that it was going to get extended again. The LA County Board of Supervisors is very progressive, and I guess I would say anti-landlord leaning. It came down to Janice Hahn voting against it and one abstention, and that abstention was probably more about whether it was an emergency or let's call it the logistics or mechanics of how and why they were voting on it, more so than being opposed to keeping the moratorium in place. So interesting thing about it is that it was the first time since the lifting of the emergency, or the COVID emergency, that the county was trying to use their emergency power to make a decision that would affect incorporated cities. They did it a bunch during the pandemic, and then coming out of it, we're going to try to do it again. I think there's probably at least those in the know or those that track this and follow this think there's still probably a good chance that a new vote comes to the table prior to the first of the month. That may potentially extend it because the leaning nature and voting track record of those in charge, they're more inclined to keep it than get rid of it. But Jason, let's for those that own multifamily that have tenants that haven't paid in a long time.
All right. So now,
quality of the building. If it stays in effect, what can people do? Who can they get?
So right now, if they extend it again, you can evict people for non-payment of rent if they make more than 80% of the area median income, which is a published figure. So you could go after them for that. There are no evictions for if it stays in effect for any just cause reason, except for what we would call OMI, which is owner move-in. You see this more on single family homes than you do on apartment buildings per se. No nuisance evictions, and you cannot evict for people that had unauthorized pets or unauthorized occupants. So like other tenants that they allowed to come in during COVID, you weren't allowed to raise rents or evict for that, even though normally you could. If it stays as it is and it expires, you can now do no fault for owner occupied move in. So non-payment of rent, you couldn't evict for substantial remodel if they're below 80% AMI in LA County. If they're above, you can now. And then the one big thing is you have to serve 30-day notices to pay or quit now, not 3-day notices to pay or quit, which would mean that you'd have to give them 30 days to pay instead of 3 before you can then file the unlawful detainer. You can also now evict for unauthorized additional tenants that aren't on the lease or unauthorized pets.
All right. So and you said a lot there, and we may ask you to run through it one more time. But
sure.
The question that's on the top of my mind right now. So my tenant owes me $50,000. I've got to give them a 30-day notice to pay me the rent that they owe, and then they're going to be in there basically 90 days before I can get them out.
So I believe, and you might know better than I do, and you can correct me, but I believe that the way the moratorium was structured was they get a year to pay you back anything owed from the non-eviction period. So they have a year to pay that amount. So you would then start evicting for non-payment of rent. So if they don't pay April rent, by the time April rent's due, then you would evict them for non-payment of April rent. But the rents that are previously owed actually become consumer debt, and they have a year to pay that. And I believe you have to pursue that in small claims court, which is interesting because normally small claims court has a $10,000 cap, but solely for this purpose, they're allowing small claims court. And the reason they're doing that is because in small claims court, you cannot be represented by an attorney. So they're hoping that it puts the landlord on equal footing with the tenant, because the landlord can't go hire a high-powered attorney to go after a tenant that has no money.
So super important to recap there. Somebody owes you a ton of money from COVID.
They have a year to pay it back.
And if they don't pay it back, I can go to small claims court, but I can't evict them?
No, then you can evict them after the year. Okay. And you can, but if you want, so you could evict them. There's two different claims, right? There's the UD eviction and then the breach of contract for the money, right? The eviction unlawful detainer is for possession of the property, and then the breach of contract would be for the dollars.
Got it.
So you can have a lawyer in the unlawful detainer for the possession of the property. You could not have one for the money. Huh. The lawyer can prep you and prepare all the documents for you, but you have to show up on your own behalf and argue on your own.
So sounds like it's still maybe even more so complicated and difficult and full of landmines for owners to try to navigate through, to make it difficult for owners to get people out who aren't paying or are disturbing other tenants or not good for the property, whatever it may be. But if steps are followed, at least in the county and unincorporated LA County, you could get somebody out. How does this relate to city of LA and any other, let's call it, cities that are, incorporated?
So most cities over the last, I'm going to call it years, most cities in the county started either adhering to the county or saying, there was no moratorium anymore. So like, for example, Glendale hasn't had a moratorium in, I want to say like 18 months. But many of the cities like Long Beach, for example, we're just going to follow the city of LA. Right. We're within the county. I think for a lot of people, it created less confusion because I think there was some confusion at times where people were like, I'm in the city of LA and, did our moratorium expire? But technically the city's within the county, and does the county apply to me? So a lot of cities just started following the county. I believe the city of LA went to that step at the last extension, which was in November, but I'll have to double check and get back.
Okay.
I think they might have been following the county at that point too, because I think the city has officially rescinded. I mean, I know the state has the emergency orders over in Sacramento. I don't think LA's pulled theirs back yet, but theirs also wasn't linked to that.
Well, even if it is, there's 42 counties in California now that are under emergency order because of weather. And evictions and rent increases are part of the things covered in the emergency order. So it might just be a new emergency.
So does the rain create an emergency order until the fires come?
Most likely.
Just check.
So we've got about 3 or 4 minutes left. We will. 2 things. One, open it up to any last minute questions about any of the topics we've covered. Jason, if we don't get some questions, you and I are going to split up 3 minutes to talk or maybe tease a little bit about what we thought we were going to talk about today, which is for somebody who's a user or has their business, whether they should be leasing or owning their property. You can start until we have a question, and then I'll jump in the last minute and a half.
There's pros and cons to whether or not you lease or own. And I think that, there's an opportunity, right? If instead of paying rent to someone and, creating passive cash flow for them, if you're creating net worth by paying down, let's say, a loan that was used to buy the building, so creating more equity, getting a return on your own capital and an investment, I think that's a positive. A negative is, you have maybe this bigger albatross of a loan hanging over the property, more responsibility, harder to move. The one thing I will say is in making that decision, it's very much a case by case basis. It's an analysis driven, and your advisors at Centennial are probably the right ones to help you. I'd like to think I'm a numbers person, but I'm a lawyer is my job. My job's not to do that sort of analysis. So I'm going to leave it up to the experts.
Well done on the timing too. To Jason's point, yeah, we can take a look at just property, and it's interesting right now. We've got a couple of examples where one, it makes great sense to go buy an office building, a suburban office building in Orange County, because financially it helps you a lot. And I think one of the benefits is that as you grow your business, being able to tap into the real estate to get equity to grow your business is oftentimes cheaper than if you're getting a loan on equipment or even the business. The rate can be a lot better. The term can be extended. And there's some advantages there compared to an industrial property that we've looked at in a great market where, it makes a lot more sense to lease it because the rate that you can lease it at makes it more advantageous for, I think, the first 14 and a half years versus owning the property. So yes, what we try to do is look at each one and figure out what is better for the business owner right now, not only as should I acquire, should I lease, but also what do I do when I'm ready to be done with this? And how do I exit? Because I have multiple options in my exit, sell them together, sell them separate, lease, space for the business, whatever it may be. And we can walk through all of that stuff with owners, and we'll show you some more stuff next time as it relates to what are the pros and cons, what are the advantages, when to do X, when to do Y, and all those things associated with that lease or own question. Jason, it's been great. I appreciate you joining me today. There were a ton of things to talk about. We expect pictures of Ford next time. He might be the largest 3-month-old in the world by that time. All of you that participated and asked us questions and joined us today, it's always a pleasure to share our expertise with you and help you get better performance out of your investments. If you need some help as it relates to looking at property today, either to acquire or sell, we'd love to be on your team. And oftentimes that means bringing Jason in to be that counsel that helps you through the process as best as it can be. Thank you for joining us today. Again, it's always a pleasure, and we do look forward to talking to you soon. And hope everybody has a great day and a great week. Thank you.
Thanks again.